Hello and welcome back to Lean on Success, where process improvement is self-improvement. My name is Ben. I'm a Lean Six Sigma Master Black Belt. And as you see, we have yet another guest joining us today. I have Mr. Scott Barber. Scott, how you doing today?
Doing great, Ben. Thanks for the time. Thanks for the opportunity to talk to you about a variety of things.
Yeah. So what I want you to do is kind of tell everybody a little bit about yourself and what you do for a living. I think they'll find that very interesting. And then we'll
Sure,
kind of get into the main topic tonight.
sure. I'm again Scott Barber, CPA out of West Virginia, uh, uh, MBA, CPA, CGMA, with about 25 years now of accounting professionally on the resume. I've done a little bit of everything from mom and pop shops to Fortune 50 companies. I've worked in public accounting, private accounting, and now I'm in governmental accounting. I was previously an accountant for the state of West Virginia, and now I work for the federal government.
Oh wow, you work for the evil empire, huh?
So to speak. Yeah, some people see it that way. Yeah, yeah,
That's hilarious.
yeah.
Yeah, I wanted to bring you on because we were having, we've been friends for a while and we were having an offline conversation about money. And you joke all the time about your job and that you push fake money around, right? And I thought that was so interesting. So I wanted to take an opportunity for you to kind of explain to the audience what do you mean when you say that, money isn't really real, that you push fake money around.
Well, I mean, I say it in an aloof sort of way, but absolutely, to a point, it's not quite being sarcastic or being all too funny about it. Uh, in that, just as a reminder to people
Mm-hmm.
that money, by and large, only has the purchasing power that we, as the general public, put into it. Money only is a construct in that the belief is there for that it has actual purchasing power, that it actually has value, so
Mm-hmm.
to speak. So whenever I say money isn't real, it's sort of a funny way for me to illustrate that it only is worth as much as what we believe as a general society is what money is actually worth. The purchasing power of money is what is believed to be the purchasing power of money.
Gotcha. Okay. So um that's a little scary to think about.
It is. And if you think about it too much, it's one of those where it's like, wow, money kind of isn't real. But I don't say this in a way to say the chicken little sky is falling. By no stretch of the imagination do I have anything but the utmost faith in
Mhm.
the economy, especially the American economy. If you look at charts over time, it's done nothing but climb in the long run. It's never
Mhm.
even depressions that we've had after the crash of 29 and similar bumps of the road of the market. It's always had a rise in
Mhm.
the general value, general market, general GDP has always risen over time. So
Mhm.
if you don't have faith in the economy, it's all going to fall apart. Now, I mean, we as in sort of like a global we.
Mhm.
But
Mhm.
I have faith that the economy is going to last. But again, when you think about it on a granular level, it's well, what is it really worth?
Mhm.
But at the same time, it's not like I have no faith in the economy.
Right.
So
Gotcha.
yeah,
Um, so when I hear about, faith and confidence, I think about if people have faith in that the economy is going to last, they're going to behave differently than people who don't. And typically we translate that to spending. And
right.
we've had a conversation about currency and the circulation of currency. And you had a terrific illustration about how our money system works in terms of how currency flows. So if you wouldn't mind sharing that with our audience, I think it's really enlightening.
Sure. Now, I preface this by saying the same thing I said to you and others we've
Mhm.
talked to about this, is that this is just a general thought experiment. This isn't anything to take for anything more than that. Don't
Mhm.
think about it too deep. It's just something to keep in mind, to be like, okay, this is how the economy really works. I used to have this explanation with new staff accountants during tax season back when I was in public accounting.
Mm-hmm.
I used to talk to them about this whenever they'd onboard, and it was just a way to illustrate, okay, this is the difference between actual cash on hand, liquidity versus revenue made in a year, is the simple
Mm-hmm.
way to put it, like
Mm-hmm.
that. And the simple, again, very simple thought experiment that I have with this is, imagine you have a town with only 3 people. And the 3 people, one of them is a barber, one of them is a plumber, and one of them is a landlord. And a person comes into town and asks for a haircut, $10. The $10 goes to the barber. The barber now has $10 to say, and says, well, I have a leaky pipe that I can finally take care of because it's going to cost $10. Goes to the plumber, pays for the leaky pipe. The plumber now has the $10. Plumber has, I can pay my rent now for the month. Conveniently, it's $10. Pays the landlord the $10, and the landlord says, I need to get a haircut. Goes back to the barber, gives the same $10. And the illustration I made with this is, imagine that happens. The overall cycle, except for the original person coming in, is that same $10 gets issued around that same way every month. So the revenue that each person has is $120 a year. 12
Mm-hmm.
times 10, 120, simple math. Again, simple thought experiment.
Right.
Don't think about it any deeper than what it is.
Mm-hmm.
So on the surface of it, everyone has $120 in revenue and $360 for the town. But there's only
Mm-hmm.
$10 that actually exists in
Gotcha.
this simple
Okay.
experiment town. So there's the same $10 is being passed around over and over again. But that's a thought experiment to show that liquidity and actual cash on hand isn't the same as what revenue is, and on a
Mm-hmm.
larger scale isn't the same as what GDP is, and gross domestic product, which is a measuring stick
Mm-hmm.
for how the economy is doing as a whole for the country. So when you have the money going around and around, the more it goes around, the greater the revenue. Again, if you imagine you did that twice a month, then you'd have
Mm-hmm.
240 for each person.
Right.
But again, same $10. So it's
Mm-hmm.
not a matter of how much cash is on hand, how much you have in liquidity. It's a matter of revenue, and that's really what we base a lot of what our economy is built on, is how well is everyone's revenue doing? How well is the money wheel turning, as I like to say? And
Gotcha. Okay.
yeah,
How does that relate to inflation? Because I think that I read, now I'm going way back to like high school economics. I
okay,
remember reading about the amount of actual cash, like actual dollar,
right.
physical dollars that are available or floating in the economy is directly proportional to like inflation rates. So have we been seeing like anomalies from a cash flow perspective? Is that what's been driving the inflation the last couple of years?
I don't think it's really so much on the cash flow side as what
Okay.
drives inflation. It's again, it's the belief in the purchasing power.
Mm-hmm.
It's more of a demand model. In my experience, it's been a demand
Mm-hmm.
model. Again, not an economist. I'll let the math nerds do the math nerd stuff when it comes to getting the
Gotcha.
forecasts and whatnot
Mm-hmm.
going on that side. But uh, as I understand it, it's more of a demand is what's causing inflation. And when something causes an inflation in one general area, such as recently been seeing housing market go
Mm-hmm.
absolutely bonkers
Mm-hmm.
in 2022. It's settled down now compared to what it was last year. But last year, the housing market was just going just absolutely insane.
Mm-hmm.
And it's whenever the housing market goes up, then you'll see rents tend to go up. And
Mm-hmm.
when rents tend to go up, costs all around tend to rise because people not only are renting personally, but professional areas are having to foot that cost for themselves as well. Another one is fuel. If fuel costs go up, then
Mm-hmm.
that trickles down into the costs of goods and services are being sold. So that's when you start seeing the driving factors in inflation by and large, as far as I understand. Again, not an
Okay.
economist, but
Yeah. Mm-hmm.
When you see that sort of thing happening, you'll start seeing inflation sort of increasing and nudging up. And you're expected to see inflation typically around 2-3% a year.
Mm-hmm.
Every year is going to be the typical inflation rate. And then you get into areas like we had toward the end of 2022 last year, and I believe it was because of the backlash of the housing market and other
Mm-hmm.
factors, as fuel was also higher last year than what it had been.
Mm-hmm.
And coupled those things together, and we ended into a short period of hyperinflation where it was around 7 to 10%
Mm-hmm.
overall. And again, what happens with that is it's the belief in the buying power of the money is what drives the actual value of the money. So you end up in a situation where I know everyone was talking about the price of eggs was insane last
Mm-hmm.
year. That seemed to
Yep.
be the talking point on social media. People were talking about, oh, eggs are $7 a dozen now, when it, typically hadn't been over 3 for the longest time.
Mm-hmm.
And
Yep.
when basic common goods like the classic one they give is butter in economics classes.
Mm-hmm.
When basics like that tend to drastically rise in price, and it actually affects people at the grocery store and in their pockets, where it hits literally close to home, that's
Right.
when it starts to get really noticed. And that's when certain measures are usually taken by the Fed in raising interest rates, or maybe even putting some tightening up the restrictions on cash on hand
Mm-hmm.
that is available out there to rein in inflation a little bit
Mm-hmm.
from when it's going insane. Like
You touched a little bit on, and you just mentioned about liquidity or the amount of cash that's on
yeah,
hand. I'm curious how much of that liquidity issues or available cash, how much of that played a factor in some of the troubled banks that we've been seeing over the last couple of weeks?
yeah, that's I'm looking very much forward to the study in future years about what happened recently with like Silicon Valley Bank
Mm-hmm.
and other banks that uh, ended up having a run put on them,
Mm-hmm.
and that ended up causing them to fail. Those of you out there who may be familiar with the movie It's a Wonderful Life, that's one of the basic plot points of It's a Wonderful Life, is they had a run on the bank and the bank fails because they didn't have enough cash on hand to satisfy all the customers who were panicking because they thought the bank was failed. Well, the truth is, and the ugly truth is about banks, is no bank really has enough funds on hand to satisfy all deposits that are made with the bank. It's just not how the design works. You only have enough cash on hand to demand what you expect to see people withdrawing or using for payments out of their checking and whatnot. But the whole point is to loan that cash back out so that you make money on it,
Mm-hmm.
you being the
Mm-hmm.
bank.
Right.
So the bank is never going to have all of the money that they have on the books when it comes to the amount that they have in total deposits. That's just not how it works by design. What happens with banks, and what happened in Silicon Valley's case, is there was essentially what they call a run on it. People started to lose faith in the bank's ability to continue as a business, and the
Mm-hmm.
larger depositors went to the bank, said, I'm pulling all of my money out, because anything over $250,000 isn't insured by FDIC in the banking world. And
Mm-hmm.
when you put money in the bank, FDIC is going to insure $250,000 if the bank goes belly up. And anything over that, you're taking on the risk by keeping your money in there, right?
Gotcha. Okay.
Well, what had happened with the Silicon Valley is several of the high investors, several of the people who had their money in the bank, were close with each other and were discussing the future of the bank, hadn't had a lot of faith in it. A run happened on the bank, and all of the money was being pulled out. And then once word got out, it was just like a fire and
Mm-hmm.
in a drought. I mean, just people were flocking to the bank trying to pull their money out before they felt it was going to go bust. And it got to the point where they had to freeze all of action on like a Thursday afternoon when the run started on Wednesday on
Wow.
on the bank deposit. It was quick. It was really
So
quick. And then
literally overnight.
literally overnight they had to
Wow.
freeze they had to freeze transactions, and that froze all the way through the weekend. And over the weekend, the FDIC and the Treasury came together and to sort of quell the public's concerns, because with that fall, another bank in New York fell for similar reasons,
Mm.
similar thought process. Well, Silicon Valley, one of the largest banks in the country, is going to fall. We know this bank is a large bank that's in a similar situation on the East Coast. A run happened on it. It fell as well. And what happened this time is the FDIC and the Treasury stepped in to say, hey, we're going to make everyone 100% solvent on everything that they had before the bank collapsed.
Okay.
And where it's usually just the 250,000, I was saying with the FDIC, the insurance is usually only that $250,000. They came in and said, everyone's going to get everything back to the dollar that you had deposited. We're doing this sort of like a one-time thing. And the reason they did that is to quell future happenings like the one in New York that happened after this one, to sort of keep everyone at ease. Like, okay, we're putting this fire out now while it's still manageable before Monday breaks and everything goes insane again. So
Gotcha.
sort of an unusual move. I wasn't looking for them to go 100%, but they went over and above when it came to making these investors whole with it. I was a little surprised that they did it that way, but so far we're a few weeks out and haven't had any other major bank fails as part of the dominoes falling from that. So it
Yeah.
appears to have been the right situation. And the other good news about that is because it's coming out of FDIC funds, the insurance funds, which are paid into by the other member banks
Okay.
across the country.
Gotcha.
It's
So
sort of
there,
it's an insurance.
right.
Banks pay premiums into this insurance, and it comes out of that insurance fund. So it doesn't come out of tax funds like the bailouts of earlier years have
Okay.
done in the past.
Yeah, I was going to ask you to clarify that because the bailout that happened in 2008, 2009 left a bad taste in a lot of people's
Very much
mouths
so.
because
Yeah.
a lot of people kind of felt helpless. And why are these corporations that are too big to fail get bailouts, but we don't?
Right.
So I'm
Yeah.
glad you make that distinction. Do you think, though, that there could be indirect taxpayer impact because the banks now have to pay higher insurance premiums?
Now that is a concern. My wife is actually president of a bank here in West Virginia, and as soon as this happened, her very first reaction was, "Well, there go our premiums." So
Yeah.
she knew immediately. She was like, "Well, this is going to fall back on all of the smaller banks throughout the country that the premiums are going to raise to sort of fill the pot back up from where this big emptying out happened to save the investors of Silicon Valley and the other banks that collapsed from this one event." So you're dead on that, and that it's probably likely going to fall back on these other banks, smaller banks, to have their premiums raised to make up for this shortfall.
So based on everything you just told me, what I got from that is there were a handful of really rich dudes that caused all of this crap.
Maybe. I mean, again, I'm looking really forward to when the dust settles on this, and years from now, there's actually a really good case study on it. But from what we can tell, at least what I can tell on the short term of it, is that's exactly what happened. Is there's even stories out there of there being a large text thread amongst the major VCs and investors in the bank that they all talk to each other on like this 200-person text thread. And they started talking to each other on the thread And that's kind of what spurred the panic. Is one of them's like, well, I'm pulling everything out. And well, if you're doing that, then I'm doing. Well, if you're doing that, then I'm doing that. And
Wow.
the panic almost spread just amongst the very few uber wealthy that were invested in this to cause this to happen. And then people who had less in it was just like, well, if those people are pulling out and they're way high in the amount they have invested, I've got to make a run as well. And again, that's what causes the collapse. Is no bank has all the money that they have in total deposits on hand. So if you're going to have a run, it's any bank that has a run on it is going to collapse. It's just a matter of, do you have faith in the bank, in the management? Do you have faith in the way that they're holding their investments, in the way that they're operating? If you have that faith in it, then you trust that whatever you have in it is going to be there when you go to access it in the future. And again, if you're under a $250,000 investor, you have absolutely nothing to worry about because you're fully insured by the FDIC.
Yeah, and I'm glad you emphasized that, because I wanted to be clear to our audience is that there's no reason for you to panic, right?
Right.
Your money's
exactly.
fully insured. You're going to be reimbursed in the event of a collapse. The turnaround for FDIC to reimburse is like days. It's not like you'll be waiting 2 months.
That's exactly right. Yeah, it's a matter of days. By and large, the public has very little to worry about when it comes to banks and investing, and that in the banking market, it's still one of the safest places for money, period, in our economy right now.
Yeah. So I'm also hearing you say that I shouldn't take all the money out of my high yield savings account and buy a bunch of gold bars and put it in a safe in my house.
Well,
I shouldn't do that.
Some people want to do that, and the gold market is it tends to be a very stable market. However, it depends on which infomercial you're listening to as to whether people really trust gold as a basic investment.
I'm from the hood, so I'm not going to buy gold bars. I'm going to get herringbones, get some, some Cuban link bracelets.
I know exactly.
I could at least need to floss. I'm going to buy gold. At least let me floss with it.
Hey, you got to at least look good, right?
Right. Exactly. Exactly.
Yeah.
This was really informative. I'm glad we had opportunity to go through that. I think the audience will find that really informative. Yeah. Any last words from you about, what we've been discussing here?
I think the last thing I wanted to touch on was we talked about the cycle of money, how money going around and around is really what grows the economy. And that's just one thing to keep in mind, that as long as money's being spent overall in the country, it's when people stop spending money that the economy kind of goes flat. It's when the spending grows, the economy grows, so to speak. That's sort of a John Maynard Keynes belief in economics, is that the more money is spent, that the more that you have growth in the economy. So, and we've seen that in the past. One thing I was going to touch on is back in the first few months of the pandemic, when the economy essentially stopped for a lot of people. Some people had loss of jobs, loss of income. And if you remember, we had stimulus checks come through. The stimulus checks were essentially twofold. Is one, and this is a Keynes philosophy as well, is that government stimulus, government releasing funds in the economy, can shoot the economy back into out of a neutral situation more into a growth situation. And that was twofold. What the government was hoping to do with stimulus checks was to get people funds that they desperately needed because they were either off of work or out of work. And two, to get those funds into people's hands and to get them spending the funds so that the economy overall gets sort of a little boost, right? And again, going back to my thought process, if you give people the money that, where a week and 2 weeks before they weren't even able to to buy groceries or gas or anything like that. Now you've got a little bit of money you can do that with. And then the people working in the stores have money coming in that they can pass on to employees who then can do the same amongst themselves. And it's that multiplier effect of a influx of cash from an outside source, like our person who come in to get a haircut to start that cycle altogether. It's that outside source of money that goes around the town. If it's spent locally like that, then it grows the local economy. If it's on a national basis, it grows the national economy. So that's just sort of the macro example of how the influx of actual cash will tend to boost the economy, but it's the spending of cash. Like we know a few people when we were talking about stimulus checks in some of our group chats that said, well, when I got a stimulus check, I actually just put it in the bank. It's the last thing the government wanted you to do was to actually save the money because then it doesn't go to anyone else's hands to get the economy the boost that it needed at the time. So that was sort of the last little thing I wanted to touch on is how that, and it's almost always either a governmental source of new money or an outside, whether foreign source of money coming in. But for the stimulus checks, it was the government side of it. But I just wanted to touch on that too, just real quick, just to show that that's the macro version of the thought experiment that I was leading off with, so to speak.
Man, that's so great. So if I could just summarize what we talked about today, money is fake. Keep it in the bank and keep spending it.
Keep it in the bank for when you need it in the bank, and spend it when you need to spend it. And and don't lose faith in the economy. That's the big overall arching picture here. Is even though money has only as much value as we as a society put into it, it's always grown in the history of the country. It's always ticked up. So we have no reason to believe that it won't continue to do that. We just came out of a one in a century pandemic, and the economy is still going up and up and up. So there's no reason to lose faith. Don't panic, I guess, is the overarching message for those who are worried about the economy overall. Don't panic. Everything's going to keep the money wheel is going to keep on rolling, as they say.
Awesome, man. Scott, this has been terrific. Thank you so much for taking the time. I really appreciate it.
Thanks for having me on again. It's always good talking to you about this kind of stuff or anything else. So I appreciate it.
All right. Just want to encourage all of you, if you like content like this, be sure to hit that like button, subscribe to the channel for more content like this. Thanks again, Scott. And until next time, everybody.